For millions of Indians, the day starts at a petrol pump. But from the past few months, something feels different as the fuel bill looked heavier. Not because oil got expensive, but because the rupee quietly fell again. In December 2025, the rupee crossed a psychological threshold, rupees 90 to the US dollar. That number matters. It changes prices, business decisions, and household budgets. This wasn't just a number flashing red on a trader's screen. This was a wake up call for every Indian investor, business owner, household, and UPSC aspirants preparing for interview and mains. But the real question is that why is this happening now despite a booming domestic economy showing robust GDP growth? Is this a signal towards something that is more systemic? Let's dive deeper into the topic. Before we dive deeper, let's get the basics right. Currency depreciation is primarily driven by the forces of supply and demand in the foreign exchange market. Depreciation occurs when the demand for the foreign currency like US dollar increases or the supply of the foreign currency like US dollar decreases. The Indian rupees fall past the psychological significant rupees 90 per US dollar mark was a result of perfect storm where both capital outflows and trade shocks pushed the demand supply balance against the Indian rupee. Let's be clear, this isn't a minor slip. The rupee's depreciation is both significant and broad based. Over the past 12 months leading up to December, the rupee weakened by 6% against the US dollar. But the pain doesn't stop with the dollar. The rupee fell even harder against other major global currencies as it fell 9% against the euro and a substantial 14% against the British pound. This widespread loss of value confirms that the pressure is systemic. And here's the most alarming indicator. When we compare the rupee's performance to its emerging market peers since August 2025, the INR registered a 2.3% slide while currencies of South Africa and Brazil actually appreciated. This divergence proves one thing: while global market fear is a factor, the rupee's fall is uniquely aggravated by India-specific vulnerabilities. The first driver is global, rooted entirely in the US monetary policy. When the US Federal Reserve raises its interest rates or when the US 10-year bond yield approaches 5%, it triggers a phenomenon known as reverse carry trade. See, understand this. Foreign investors traditionally borrowed money cheaply in developed markets like the US and invested it in high growth, high return economies like India. This was the profitable carry trade. But when the US makes its own US treasuries more profitable by hiking rates, it motivates these foreign investors to liquidate their holdings in volatile markets like India and bring the capital back to the US. They are selling rupees and buying dollars, instantly driving up the dollar's demand and strength. This financial pullback manifested in dramatic capital flight. Foreign institutional investors and foreign portfolio investors have been net sellers, erasing the demand for rupee and intensifying dollar demand. The scale is staggering. Net FII outflows for 2025 have already crossed 17 billion US dollars. This massive withdrawal, driven by rising US bond yields and generalized dollar strength, directly eroded the INR's stability. The second and perhaps most devastating factor is an acute India-specific geopolitical trade shock. This shock immediately destroyed the critical supply of dollars coming from India's exports. Following disputes over Indian oil purchases, the US aggressively escalated tariffs on Indian exports. US duties rose sharply from 10% in April to 25% in early August and finally spiking to an astonishing 50% by the end of August 2025. Compounding the problem is the structural demand for dollars driven by imports. This is largely because India is a huge importer of crude oil and gold, which analysts estimate even a modest fall in the rupee raises India's import bill by billions, especially for oil, and that can push up fuel and transport cost at home. The Indian rupee is thus caught in a financial vice. On one side, massive capital flight is draining the dollar supply. On the other side, crippling US tariffs are cutting off the oxygen. The growing trade deficit acts as a constant pressure, tightening the vice. A weak rupee has profound and challenging effects that touch every sector of the economy. The most direct threat is imported inflation, since critical items like crude oil, electronics, and key industrial components are priced in dollars. A depreciated rupee makes them significantly more expensive. A weaker rupee also means we pay more for the imported fuel, electronics, and potentially even certain food items. A single rupee depreciation is estimated to add $15 billion to the total import bill and specifically 8,000 to 10,000 crore to the crude oil import bill. This risk of imported inflation complicates the RBI's job to control inflation. Despite low domestic inflation in the recent months, the rise in imported cost may force the central bank to remain cautious about cutting interest rates to support growth. The question many are asking is this: if this situation is so severe, why hasn't RBI intervened more aggressively? The answer is complex and lies in a fundamental shift in the RBI's exchange rate philosophy. The RBI has moved away from its old model of aggressively defending a fixed nominal exchange rate. Instead, it has adopted a policy of calibrated flexibility. Its focus is not on fixing a specific rate but on ensuring the rupee's movement is smooth. Why? Because the RBI believes the soft currency is not a bad thing from a foreign trade standpoint. Allowing depreciation is a deliberate strategy, leveraging the rupee to act as an effective external shock absorber. This is crucial for correcting the severe trade imbalances and improving export competitiveness, especially when facing unilateral tariff actions like the 50% US tariffs. This strategic choice is backed by data on the real effective exchange rate, or REER. The REER measures rupee's value against a basket of currency, adjusted for inflation, determining its true purchasing power and competitiveness. The REER index plunged from an overvalued 108 in November 2024 to 97 in October 2025. A reading below 100 confirms the INR is currently fundamentally undervalued. This undervalued status gives the RBI the green light to prioritize stability management over an outright defense. Having said this, long-term stability requires action that addresses the root causes: volatile capital flows and acute exposure to geopolitical trade shocks. The immediate determinant of the rupee's near-term trajectory is not domestic interest rates, but trade diplomacy. A rapid diplomatic resolution and a negotiated breakthrough in the US-India trade deals are paramount. This must focus on removing the crippling 50% US tariffs to restore confidence and revive the dollar supply pipeline from exports. Analysts widely agree that rupee's recovery hinges on this agreement. However, until the US trade uncertainty is resolved, the rupee is expected to remain under pressure. Additionally, India needs to prioritize stable foreign direct investment over volatile FPI. FDI, which is focused on infrastructure and manufacturing, is sticky and less prone to capital flight triggered by US Fed moves. We must accelerate structural reforms to boost merchandise export competitiveness, diversifying dollar earnings beyond services exports to mitigate the impact of future single country trade shocks. Finally, achieving stability requires synchronized action. Monetary policy of the RBI must be strategically aligned with the fiscal policy of the government to restore investor confidence and promote long-term investment. The rupee is currently functioning like a sophisticated suspension system on a high-speed vehicle. It's intentionally softening to absorb huge, sudden bumps to prevent the entire vehicle, the Indian economy, from crashing. The depreciation is painful, but it is allowing India to maintain speed and correct trade course, providing the source of the bumps is resolved quickly.